Hello, this is Mike Foreman with Game Plan Retirement with another extended version of Let's Ask Mike. I've spent pretty much my whole career working with investments, retirement plans, retirement planning, and many individuals. And a key component of that planning is often Social Security and when the best time to take benefits is and what the ramifications of different choices are. And I worked for many years with a group called Nationwide Insurance, who has a group that I work with there that helps me with reports that can analyze the different situations that clients are in and help them make the best choices. So today I'm going to do an extended Let's Ask Mike and go through a presentation I sometimes give in person, especially at companies I work with. And hopefully it'll shed some light on some of the ins and outs of Social Security so that when it comes to be your time to take benefits, that you'll make the best choice for you and your family. That's my goal. Um, so let's get right into it. So first off, it's important that I mention that I have various investment licenses. I have a Series 7, and I am a registered, and I am also an investment advisor representative, and also have insurance license, and I clear through Lincoln Financial Advisors. So today I'm going to talk about how to maximize what for many people is the single most important monthly paycheck they'll ever receive in retirement, which is Social Security. I also want you to come away with knowing that Social Security benefits provide a protected level of income that cannot be outlived. Before we get into some of the details about what we're going to talk about today, I just want to say that Social Security planning can be complicated. You're not alone if you feel that that's true, because it is. This is a great opportunity to work with someone like me, and I'd love to be your partner. So I believe that I can help you make the right decisions for you and your family, and that is definitely my goal. So some important things you should know. None of this material is a recommendation for you. I'd need to get information from you on your personal situation and utilize the resources that I have available, perhaps do a financial plan to help come up with the right choices for you. And so it's important that you know that. I'd need, more information. I help clients analyze their retirement options with the help of this division of Nationwide. Again, they're called the Nationwide Retirement Institute. They're tasked with breaking down and simplifying some of the biggest issues that retirees face. I've gone to them with lots of complicated cases, and they do that by offering me education and insights. And they've offered this presentation to me and allowed me to use it, and I really appreciate that. So let's talk about Social Security. The chart I'm showing you now shows the impact of your claiming age can have on your monthly benefit. While you can file as early as age 62, you'd receive a reduced monthly benefit. You can delay up to age 70, and if you do that, you can increase your monthly benefit by as much as 80%. So it's a very important choice, and clearly many people would benefit from waiting as long as possible to file. But a lot of people file earlier for various reasons. Sometimes it's because they don't know about any of this. They've kind of made a decision how they're going to, when they're going to leave their work and do other things before they've really done the math. And sometimes it's because they really just can't find income in those years. So again, with your personal situation, I'd be happy to help analyze what's best for you. These figures here on this chart are based on an individual with a full retirement age of age 67, and it compares filing then with filing at age 62 and receiving a reduced benefit, which would be 71% less. If you wait till age 70, it'd be an increase of up to 25%. So the rest of the agenda today, that's really the reason that we're having this conversation, is we're going to look at why the Social Security filing decision is the choice of a lifetime and why your filing decision matters. Then we'll get into some of the basic benefits that you want to know about Social Security. We're going to talk a lot about survivor benefits and the rules for spouses, divorcees, etc. And we'll review recent filing rule changes and implications to filing strategies. Finally, we'll talk about the various filing strategies you can use when making your Social Security decision and how you can optimize Social Security income for your specific needs. My hope is after this discussion, you're going to say, wow, I feel like I know a lot more about Social Security than I did before. That's my goal. So let's start with a look at why the Social Security decision is so important. We say it's the choice of a lifetime because you generally get only one chance to make this decision right, and the consequences of your decision will last the rest of your life. Not to scare anybody, but these are true statements, including the life of your spouse if you're married. Most Americans have a base level of understanding of how Social Security works. You pay into the system throughout your career. Then, after you're at least age 62, you can elect to begin receiving monthly income for the rest of your life. I'm going to tell you one of the most important things you need to know on this first slide. Your decision of when to file for your Social Security benefits can have a large impact on the amount of benefit you receive. And we'll talk through how that works. On this slide, you'll see a range of ages on the bottom of the chart, beginning at age 62 and ending at 70. You can begin receiving your Social Security benefits at any point along the range, and there are financial implications as you move across that range. What do most people do with their Social Security decision? This chart shows a snapshot of when new Social Security claimants took benefits during a calendar year. As you can see, nearly half of people, or 49%, filed earlier than full retirement age. In fact, 1/4 of the filers, 25%, started benefits at age 62, which is the earliest possible age. Unfortunately, that also has the largest reduction. There are multiple reasons that people might do that. Many may simply need the money or are physically exhausted from a lifetime of work. They may be forced into retirement sooner than they planned due to layoffs or health issues. Some people may doubt the future solvency of Social Security. It's also possible to delay your benefits beyond your full retirement age up to age 70. In return for delaying, you can earn credits that increase your monthly benefit when you decide to take them. As our life expectancies continue to increase, we will all need to account for that added longevity in our retirement savings plans. If you're able to delay accessing your Social Security benefit, you might be able to increase that method of guaranteed income, and I'll show you some examples on how. So let's look at a few examples of how Social Security filing decisions can impact one hypothetical couple. So please note the actual scenarios are different than the examples we'll use during this presentation. So let's talk about Pat and Kelly. So Pat is 66 and Kelly is 61, and they've been married for over 30 years and are in a high income group based on their household assets of $500,000. Pat's monthly benefit is $2,600, and Kelly's current monthly benefit at full retirement age is $1,900, based on her lower earning history than Pat's. So let's look at the outcome that different Social Security filing decisions would have on Pat and Kelly, and compare the differences between filing as soon as possible and their optimized filing strategy. If Pat files right now and Kelly files at 62, they will take a permanent reduction in benefits of just under 15%, and they would accumulate over $1.45 million during their retirement. We're making some assumptions here, such as a life expectancy of age 85 for Pat and 88 for Kelly, a future dollar value benefit, annual cost of living adjustments of 2.4%. If we have Pat and Kelly wait to reach their optimal benefit, they need to delay filing until Pat is age 70 and Kelly is age 66, allowing the couple to accumulate nearly $230,000 more in expected Social Security benefits over their lifetimes. That's real money and can significantly impact a person's retirement earnings. Now let's look at an unmarried retiree, Mary. Please note that the actual scenarios, again, will be a little bit different than we use. They'll be a little bit different. For this example, we'll assume that Mary is 60 and single. We're also going to assume that she has a comfortable nest egg of retirement savings, enabling her to draw income early from her savings and explore delaying Social Security benefits. Let's help Mary with a comparison of her benefits should she file at age 62, 67, or full retirement age, or age 70. As you can see, if she waits even 5 more years and files at age 67, she would gain just over $79,000 in cumulative benefits. If she waits until age 70, she could gain over $125,000 more in cumulative benefits. Mary estimates her life expectancy at around age 89. If she were to live even longer than that, the benefit of waiting to age 70 would be even greater. So now I want to show you a chart that helps show why it's important to plan for your Social Security benefits. This is a study that was done by the U.S. Census Bureau that looks at households where the primary bill payer or householder is age 65 or older. As you can see, this shows that many retirees are getting a significant portion, over half, of their income from Social Security benefits. If you're relying on Social Security income, you'd want to make sure you're getting as much of it as possible, right? These are averages, and not everyone is fortunate enough to have a pension or rental income, which makes it even more important to know the tips I'm going to share with you today. If you want to include details on what is included in some of the numbers, pension and retirement income includes retirement, disability, survivor, life insurance, and annuity income. Property income includes income from interest, dividends, rents, and other assets held outside of retirement accounts. Other income includes unemployment compensation, workers' compensation, veterans benefits, and other cash income sources. So let's take a step back for a few minutes. Before you get into a Social Security discussion or planning, there's some basic information that you should be familiar with. I know that Social Security rules are kind of complex and can also be confusing, but like I said at the beginning of the presentation, I'm going to break it down and simplify them to hopefully help you have a productive conversation with me when you're ready. So what does Social Security, what is Social Security and what does it offer? So the official name is Old Age Survivors and Disability Insurance, OASDI. So that tells you who the program is designed to aid. The Social Security Act was signed by President Franklin D. Roosevelt on August 14th, 1935. It was created to help older Americans during the Great Depression. In 1935, unemployment was over 25%. The majority of elderly citizens were poor. Social Security was designed to alleviate the financial hardships that many older Americans were experiencing due to the Great Depression. Social Security was never meant to be the sole source of retirement income. That's some of the background, but why is Social Security so important today? Well, the Social Security Act, again, was signed by Franklin D. Roosevelt on August 14th, 1935. It was created to help older Americans during the Great Depression. In 1935, the unemployment rate was over 25%. The majority of elderly citizens were in poverty. Social Security was designed to alleviate the financial hardships that many Americans were experiencing due to the Great Depression. And it was never meant to be the sole source of retirement income, as I just said. So this is Ida Fuller. Was a Vermont resident. She was the very first recipient of monthly Social Security benefits. She worked as a legal secretary until she retired in 1939. She started collecting benefits in 1940 at age 65, and she ended up living to be 100 years old. She died in 1975. She paid payroll taxes during only her last 3 years of employment. The accumulated taxes on her salary for those 3 years were just $24.75, not adjusted for inflation, obviously. Her first check was for $22.54 in 1940. So she collected a total of $22,888.92 in Social Security benefits by the time she passed away in 1975. Definitely a bit of a lifesaver for her. Now, let's talk about some of the calculations. So a person's primary insurance amount, or they call this PIA, is the monthly benefit that you're eligible to receive at your full retirement age. the Social Security Administration calculates each person's PIA by averaging the 35 highest paying years of wages and then multiplying that average by a percentage. Therefore, the higher a person's lifetime income, the higher their benefits. There is a cap, though. In 2023, the maximum monthly Social Security benefit for someone who files at full retirement age is $3,627. For anyone electing to file early, their benefit will be reduced. Likewise, if someone delays beyond their full retirement age, their benefit will be higher than their PIA. So how does the IRS calculate this primary insurance amount? First, they use a person's average indexed monthly earnings, or AIME, A-I-M-E, which is calculated over his or her highest 35 years of earnings. The PIA is calculated by adding 3 separate percentages of different portions of a person's AIME, A-I-M-E, yeah. The segments of AIME used for the PIA calculation are determined by bend points set by the IRS. Bend points are selected for the year in which the individual turns 62, even if benefits are not applied for until later. For 2023, the bend points are $1,115 and $6,721. So the PIA for someone turning 62 this year would be calculated as follows. 90% of their first $1,115 of their AIME, plus 32% of the next 5,606 up to the bend point of 6721, plus 15% of the AIME over $6,721. So an example can help explain the PIA calculation, and let's just do the math for a hypothetical person. Jim's AIME over his 35-year work history is $6,715. 90% of the first $1,115 of AIME is $1,003.50. So 32% of the rest of his AIME, $5,600, remains is $1,792. His AIME does not exceed $6,721, so that part is zero. Add these together for a PIA of $2,795.50. Because your benefits are so closely tied to your earnings, it's important to review your Social Security statement. You can go to the My Social Security website at ssa.gov/myaccount, and once there, you'll be able to create an online profile and access your current Social Security statement and your full earnings record. The Social Security Administration no longer mails these statements annually to people under age 60. Instead, they mail paper statements only to those age 60 and older who do not have a My Social Security account. Here you'll see what the Social Security statement looks like if you haven't seen one. These statements include a worker's current PIA, their estimated benefits depending on when they file, their earnings record, and other general information and facts about Social Security. On the first page, note the clearly displayed retirement benefit estimates, along with estimates for disability benefits and survivor benefits. You'll see a clear breakdown of monthly benefits based on the age when benefits begin. And on page 2, it shows details on a worker's earnings record, including a year-to-year breakdown of earnings and estimated total amount paid into Social Security and Medicare over their career. The next important acronym to know is FRA, or full retirement age. It used to be age 65, and many people still believe 65 is full retirement age. But right now, full retirement age is currently 66 for anyone born between 1943 and 1954, and for anyone born between 1954 and 1960, FRA is gradually increasing to age 67. FRA for anyone born in 1960 or later. It's 67. Early filing can occur starting at age 62 up to the full retirement age. For anyone born in 1955 or later, your 66th birthday is considered early because of the gradual increase in the FRA. You can delay filing up to age 70 and increase your benefit amount, as we'll see on the next slide. I know there may be some of you participating that will reach full retirement at age 66 and 6 months, 8 months, or 10 months. But for the ease of explanation, I'm going to reference full retirement age as 67, which affects those of you born in 1960 or later. How does filing earlier or later than FRA affect the PIA? Well, filing as early as possible at age 62 results in a permanent reduction in benefits of 30%. Benefits reduction decreases the closer you get to FRA. Delaying benefits increases the PIA by 8% each year up to age 70. For someone with an FRA of 67, they can increase their monthly benefit by 24% just by delaying benefits as long as possible. The slide really shows you the financial impact of taking Social Security at age 62. So while you can indeed begin your benefits at that age, it's really important to weigh that against the potential loss of income you'll face by not delaying as long as you can. We mentioned this earlier, but another key feature of your benefits is that they're adjusted annually for inflation. And because of our stubbornly high inflation levels, this year we saw one of the highest increases in recent history at 8.7%, benefiting both those that have filed and those that haven't. So cost of living adjustments, or COLAs, are pegged to the annual inflation rate and have been a feature of Social Security benefits since 1975. The chart shows the historic trend of Social Security COLAs since 1990. The historic average over this period is 2.47%. Social Security is projecting that inflation will be about 2.4% for the next decade, but this could certainly change. So how is a COLA calculated? The Social Security Act specifies a formula for determining each COLA based on increases in the Consumer Price Index for urban wage earners and clerical workers, or CPIW. CPIWs are calculated on a monthly basis by the Bureau of Labor Statistics. Essentially, they have the CPIW from the third quarter of the current year to the CPIW of the third quarter of the last year. There was a COLA. The new COLA will be equal to the percentage increase, if any, between those two numbers. If there is an increase, it must be rounded to the nearest 0.1%. If there is no increase, or if the rounded increase is 0, there'll be no COLA that year. So Social Security provides different levels of benefits for a variety of people in different situations, which is where people like me can come in and be helpful. I can help you review your statement, consider your unique circumstances, and help you identify a filing strategy built around our suggestions. It's important that you learn a few details that many people just don't know. Your unique situation matters when filing for Social Security benefits. We're going to focus on the top 3 situations: surviving spouses, and divorced spouses. But I do want you to be aware that there are also special rules for dependent children, disabled individuals, and government employees. So let's start the discussion of the filing rules with what will probably be the most common scenario: married couples. So spousal benefits can represent significant dollars for a non-working, low-benefit spouse. I want to take a moment here and say that since 2015, spouses also include same-sex married couples. There are a lot of filing rules for the spouses, and they can be complex. Knowing how to apply the rules effectively can help married couples get the most from their benefits, especially when it comes to providing income for the surviving spouse. Spouses are eligible for benefits based on their working spouse's record. To be eligible for spousal benefits, the spouse must be 62, married for at least 1 year. Filing for spousal benefits also reduces benefits. The primary worker has to have already filed for benefits. And what's the benefit of the non-working spouse? The spouse can receive up to 50% of the worker's PIA. If claiming both individually and as a spouse, the spousal benefit will be subject to the spousal adjustment, which is the individual benefit minus 50% of the spouse's PIA. Like I said, filing strategies for married couples are very complex. Most strategies for married couples differentiate with the use of spousal benefits. They cannot receive spousal benefits only if filing prior to FRA, it is considered a deemed filing. In other words, you are filing for all eligible benefits. Filing for spousal benefits at full retirement age allows the individual to earn credits on the individual benefit, subject to the maximum family benefit of 150% or to 180% of the higher income earner's PIA. For those of you that are married, it's also important to know how the rules for surviving spouses work. The survivor benefit is at least PIA, but can also earn credits. So it's important to think about survivors when beginning Social Security. Would you rather your surviving spouse receive the amount of money you get from when you turn 62 or when you turn 70? Most people would say that they want to max out the benefit for their surviving spouse. So that's something to think about. A widow or widower is eligible based on their deceased spouse record. Benefits are available as early as age 60. The qualification being that you've been married for at least 9 months. If you have any dependent children under 18 in the house, they're also eligible for a survivor benefit. So what is the benefit? The maximum benefit a survivor receives is the greater of the deceased spouse benefits, including delayed investment credits, retirement credits, or 82.5% of the deceased's PIA. This is because the Social Security Administration limits benefits depending on whether and when the deceased began benefits. Depending on when the survivor elects to begin benefits, the individual will receive between 71.5 and 100% of the survivor benefits, a one-time death benefit. Also, this is one of the few instances you can begin claiming one Social Security benefit and then switch to another benefit at a later time. For example, let's say you and your spouse are 60 years old and you have matching Social Security benefits. At age 60, you pass away. Like I said, before you began claiming spousal survivor benefits at age 60. So even though the benefit will be reduced by claiming early, your spouse can begin taking that money and hold on to their own Social Security benefit until they turn age 70. Their spousal benefit has time to reach its maximum value, and at 70, your spouse switches to that higher benefit. You want to maximize the higher benefit because that's what you're going to get for the rest of your life. There are a lot of moving parts here. The point is to remember that if you're widowed, you're in your 60s, and you have your own benefit plus a survivor benefit, you're going to want to think about your claiming strategy to maximize whichever one is higher. All right, so let's talk about divorce. If you're divorced, you may also be eligible for Social Security benefits based on your ex-spouse's record. When you're divorced, it is all about how long you were married, and that magic number is 10 years. If you are married for 10 or more years, you maintain the same rights that you had for your ex-spouse's Social Security as if you were still married. So you could collect a spousal benefit or you could collect a survivor benefit, but certain rules do apply. Like I said, the marriage must have lasted for at least 10 years. You must be unmarried, but it doesn't matter if your ex-spouse gets remarried. Benefits can begin at age 62, and you do not need their permission or cooperation to claim the benefit. You're going to need to know their Social Security number and date of birth, and you're going to need to be able to prove that you were married for 10 or more years. Your ex-spouse doesn't even need to know about this. When it comes to a spousal benefit, you need to be unmarried, but when it comes to a survivor benefit based on your ex's Social Security benefit, the story is a bit different. For the survivor benefit, if you are under age 60 and get remarried, You are ineligible for a survivor benefit based on your ex. If you get married after age 60 and your ex dies, you may still be eligible to claim a survivor benefit. So that's something that's important to know. Many individuals may fall under these eligibility requirements, but are unfamiliar with the rules. It's also important to consider any other family members who may be eligible to receive benefits from the Social Security Administration. For example, children who are under age 18 and unmarried may also be eligible for Social Security benefits based on their parents' records. 40% of all families lived with their own children under age 18, based on the U.S. Census Bureau. Collect based on the retired parent. The parent must have filed for benefits, be age 62 or older, and be fully insured, meaning they already earned 40 credits to qualify for Social Security benefits. They collect survivor benefits from deceased parents. Children can collect if their parent dies before age 62. Two conditions need to be made in order for a child to collect benefits from a deceased parent. The parent must have had 1 credit of coverage for every year between age 21 and death, 6 credits in the years before death. There's no early claiming reduction for children's benefits, but also no delayed retirement credits on these benefits. Please note that additional children benefits may be eligible for benefits. 18 and 19, up to 2 months past their 19th birthday, if still attending primary or secondary school, and 18 and older if disabled, as long as the disability started before age 22. The benefit is 50% of the retired parent's PIA, primary insurance amount, or 75% of the deceased parent's PIA, primary insurance amount. Also note that if someone provides care to a dependent parent, the parent may be able to collect benefits based on their child's record. The child must file for individual benefits at age 62 or older, and a dependent parent is a parent over age 62 receiving 50% of their support from that child. This has the biggest impact if the supporting child were to pass away. Family members who are also disabled may qualify for benefits from Social Security. If an income earner is disabled, benefits for the spouse may be available prior to age 50. Spousal and survivor benefits, dependent children are allowed to collect as long as their disability occurred before age 22. Eligibility. The individual must have a qualifying medical condition. The Social Security website includes an extensive list of impairments that covers a wide range of medical conditions. Recent work test. Had the individual worked recently enough when the disability occurred? Duration of work. Had the individual worked long enough to be fully covered by Social Security benefits? There are government employees that have some special considerations to consider when it comes to Social Security benefits. I'm going to walk you through a couple considerations, and we'll go through more in depth in the next few slides. So if someone you know or you work for the government, this is for you. Your government job may not provide Social Security coverage. Some state and local government employees are not eligible for Social Security benefits. This exclusion may come for employees that are enrolled in a retirement plan that meets federal regulations. If your work history includes a mix of both public and private sector employment, your private sector Social Security benefits might be reduced if you also qualify for a public pension. The Windfall Elimination Provision, or WEP, and the Government Pension Offset, or GPO, reduce benefits for some employees who qualify for a pension from work and didn't pay into Social Security. These provisions were designed to prevent a windfall from collecting both Social Security and public sector pensions. The WEP may reduce your Social Security benefit. This reduction cannot be more than half your pension amount, and $512 is the maximum reduction for 2022. The GPO may reduce spousal and or survivor benefits. A dollar amount equal to 2/3 of your government pension may be subtracted from your spousal or survivor benefit. So now let's talk about how some of these things, in more detail. So the first provision we'll cover is the windfall elimination provision, or WEP. It applies, again, if your work history includes both Social Security covered work and non-Social Security covered work that qualified you for a pension. This provision does not exclusively impact government employees. It could affect anyone who earned a pension in a job that they did not pay into Social Security through FICA taxes, governments, nonprofits, international companies, etc. If a client has 30 years of earnings that paid into Social Security through FICA taxes, this provision does not apply. WEP adjusts the formula used to calculate Social Security benefits. The reduction cannot be more than half of the pension amount. The maximum reduction for WEP in 2023 is $558 per month. So let's look at how WEP works. As we discussed earlier, Social Security benefits are based on your average indexed monthly earnings, or AIM, which are determined by your 35 highest paid years of Social Security covered work indexed for wage growth. The formula to the left shows how your Social Security benefits are generally calculated. However, you can see the formula changes with the calculation to the right when you're subject to the full WEP reduction. Instead of receiving 50% of your first $1,115 of AIME, you'd only receive 40%. That could mean a reduction of more than $550 per month. Now let's look at an example. Mary worked for both in the public sector and the private sector and qualifies for a government pension and Social Security benefits. She has an AIME of $4,000 and is subject to the full WEP reduction based on her work history. Her Social Security benefit without WEP would be $1,926.70. But her Social Security benefit with the maximum WEP reduction is $1,369.20. So, which reduces Susan's monthly benefit by $557.50 per month. Now, the second provision we'll discuss is the government pension offset, which affects retirees who qualify for a government pension from work, which did not pay into the Social Security FICA taxes, and are collecting Social Security spousal or survivor benefits. This provision reduces your spousal survivor benefits by 2/3 of your government pension. If your government pension is large enough, the entire spousal or survivor benefit may be eliminated. So let's look at an example again with Kelly and Pat. So Kelly worked for the government and did not pay into Social Security through FICA taxes. She qualifies for a $3,000 monthly pension. The government pension offset would be 2/3 of Kelly's pension amount, or $2,000 per month. Pat worked in the private sector and paid into Social Security through FICA taxes. His Social Security benefit is $2,500 per month. Under normal circumstances, meaning if the GPO didn't apply, Kelly would qualify for spousal benefits of $1,250 per month and survivor benefits of $2,500 per month once Pat passes away. But because GPO does apply, both Kelly's spousal and survivor benefits are reduced. Kelly's spousal benefit is completely eliminated because the GPO is greater than what the spousal benefit would have been, which is $2,000, which is greater than, of course, $1,250. And the survivor benefit is reduced by $200 by $2,000 to $500. Many people also consider continuing to work while receiving Social Security benefits, but depending on a person's age, Social Security benefits may be reduced. These benefits are not lost, rather they are withheld until the person reaches full retirement age. At that point, Social Security benefits are increased to account for the amount of earned income that was withheld. If under the FRA for the entire year, $1 of Social Security benefits is held withheld for every $2 of earned income above the annual limit. In the FRA year, the year you become full retirement age, $1 of Social Security benefits is withheld for every $3 in earned income. In the month of your full retirement age and beyond, Social Security benefits are not reduced. I like to tell people that if you are below full retirement age and still working, it's probably best that you don't claim Social Security. The rules are kind of confusing, and it's just easier to wait until you're finished working. If you are at full retirement age and decide that you're going to continue to work, then go for it. There's no more withholding and no more limit on your earnings. At that point, it would be much simpler to tap into your Social Security benefit while continuing to work. However, if you're still working, why not continue to let your Social Security accrue as long as possible to get closer to the maximum benefit? It's just something to think about if that's your situation. So you may also be concerned with how Social Security benefits will influence how much tax you pay on all of your income. So Social Security isn't taxed like other sources of income because a portion of it, at least 15% for everyone, is tax-free. The primary retirement assets, pensions, and 401ks are all taxed much higher than Social Security. Social Security income has advantages compared with traditional retirement income because it's only partially taxed. Other sources of retirement income, such as Roth accounts, health savings accounts, and loans from cash value life insurance, all offer tax-free income to retirees. So it's important to consider how retirement assets are taxed when making decisions in retirement. When filing early, in order for you to reach your desired income, you'd have to rely on other taxable assets such as 401ks and pensions. Relying on those sources of income results in higher taxable income. Having more income from Social Security or other tax advantage reduces those taxes. In our Pat and Kelly example, we have a married couple whose annual income goal in retirement is $90,000. Filing early results in a lower Social Security benefit of $30,690, forcing them to draw down over $59,000 from their IRA accounts to meet the $90,000 income goal. Relying more on fully taxable assets increases your provisional income. If someone were to delay benefits and receive $54,000 a year, they would draw only about $36,000 from an IRA account to reach their desired annual income. This lowers their provisional income as well. Social Security is taxed at a maximum of 85% of the benefit. The amount of Social Security that is taxed is subject to 3 tests. These tests are embedded in the IRS publication 915 worksheet used to calculate provisional income and determine taxation of benefits. In our example, filing early results in a higher taxable income due to a higher modified adjusted gross income for Social Security benefit taxation, which increases the amount of Social Security benefits that get taxed. It is important for you to consider how Social Security filing will affect your taxable income. The filing decisions can have implications for your taxable income in retirement. Today, many retirees are working longer for a variety of reasons. If that's a consideration for you, it's important to understand the impact of filing for Social Security benefits and continuing to work, especially if you've not yet reached your full retirement age. Let's look at an example for Pat, who's filing before full retirement age and continuing to work. Filing at age 64, filing FRA is 66 and 10 months. Monthly Social Security benefit is $1,700. Pat's annual salary is $50,000. Because Pat is filing early and is still working and his income exceeds the earnings test limit for 2023, which is $21,240, then $1 is withheld from his Social Security earnings for every $2 above this limit. Because $1 is withheld for every $2 above the limit, we then divide $28,760 by 2 giving us $14,380. The total amount of Pat's Social Security benefit that will be withheld this year. Looking at the chart, you can see these withholdings are not prorated throughout the year. Pat's full monthly benefit is withheld until the entire amount subject to the earnings test is accounted for. Also, looking at September, you see that the partial monthly payments were not made. Despite needing only $780 in September to reach the full annual withholding of $14,380, September's full payment of $1,700 is withheld. The additional $920 that it was withheld is paid back the following year. Clearly, the earnings test has a huge impact between what Pat's annual benefit would have been, $20,400, and what Pat actually received, $5,100. As you can imagine, those unaware of the earnings test or perhaps unsure of how it works could have a very unpleasant surprise if they're expecting this income. This earnings test applies if you are receiving your own benefit or a spousal or divorced or survivor benefit. So let's look at another example. This time with Kelly, who is filing in the year she will reach her full retirement age. Kelly is filing early as she turns age 66. However, her full retirement of 66 years and 6 months will be later this year in October. Her monthly Social Security benefit is $2,000. Her annual salary is $96,000. Because Kelly is filing early, she will be subject to the earnings test. But keep in mind, the earnings test rules and limits are different when someone files in the year that they reach their full retirement age. That limit is $56,520 in 2023, and $1 is withheld from every 3 above this limit. Also, as we mentioned, Kelly will reach her full retirement age in October. Therefore, only her income from January through September is considered against this limit, earning $8,000 monthly. January through September, or 9 months, is $72,000 and considered for the earnings test. So take Kelly's $72,000 of income in January and September and subtract $56,520, the earnings test limit in 2023, for those who file in the same year they reach their full retirement age. That gives us $15,480, the amount that Kelly is above the limit. Because $1 is withheld for every $3 above the limit, we divide the $15,480 by 3, giving us $5,160, the total amount of Kelly's Social Security benefit that will be withheld this year. Once again, looking at the chart, you see that partial monthly payments were not made. Despite needing only $5,160 to cover the full annual withholding amount, the full payment of $2,000 is withheld through March. The additional $840 that was withheld is paid back the following year. So let's talk about the final steps to planning for your Social Security. First, try to get a good understanding of your Social Security and how it works and what the filing rules are. Today, hopefully you gained something from this. If this interests you and it's something you want to get into deeper with, please contact me. And I'll be happy to do everything I can for you. And appreciate your time. That was a lengthy presentation of Let's Ask Mike. If you made it all the way, I appreciate that. At the end of the day, think through what you plan to do for Social Security. Reach out to me if you think I can be helpful. And I hope that helped a little bit and created the opportunity for you to stop and think about it. So thank you again for watching Let's Ask Mike. And I appreciate your attention and hope you have a great day.